Welcome to our comprehensive guide on understanding the balance sheet, crucial for your JIIB and CAIIB 2025 exams. From the exam point of view, mastering the balance sheet is fundamental. This video will break down its components, making it easy to grasp even complex concepts. Welcome to Stu-C TV, your dedicated platform for professional bankers. We're here to help you ace your exams so that you get your 3 salary increments at the earliest. Today, we're diving into the balance sheet, a core financial statement used to study health of a business firm. A balance sheet is a snapshot of a company's financial health at a specific point in time. It lists what a company owns, what it owes, and the owner's stake. Let's explore the fundamental elements that make up a balance sheet: assets, liabilities, and owner's equity. The most crucial concept is the accounting equation. Assets equal liabilities plus owner's equity. This equation must always balance. In India, balance sheets are typically presented in 2 forms, the T form and the vertical form. Both convey the same information, just organized differently. Here we illustrate both the vertical and T forms of a balance sheet, commonly used in Indian financial reporting. Now let's break down the liabilities and owner's equity sections. Liabilities represent what a company owes to outsiders, while owner's equity is the owner's claim on the company's assets. Current liabilities include accounts payable, short-term bank borrowings, and other obligations due within 1 year. Long-term liabilities like term loans and bonds are due beyond a year. Owner's equity includes share capital and reserves and surplus, representing the owner's investment. Next, let's move to the asset side of the balance sheet. Assets are what the company owns. They are classified into current assets, fixed assets, and long-term investments. Current assets are easily convertible to cash within a year, such as cash, marketable securities, and inventory. Fixed assets are long-term assets, divided into tangible assets like land and machinery, and intangible assets like patents and trademarks. Let's focus on 2 important concepts: depreciation and amortization. Depreciation is implied for tangible assets. Amortization. It is the sum written off from the intangible asset because of their usage over their useful life. Like depreciation, this is also a non-cash expenditure. When analyzing a balance sheet, users should be aware of 3 basic questions. What is it? A balance sheet? Whose it is? Name of the firm. When is it? As on what date? Also keep in mind that the date on a balance sheet indicates the financial position on that specific date, unlike a profit and loss account, which covers a period. Order of liquidity on the asset side is as follows. Items on the asset side are typically placed in order of their liquidity, with the most liquid assets, current assets, presented first. Fixed or long-term assets, intangible assets, and investments are shown at the bottom. Order of repayment on liability side is as follows. On the liability side, current liabilities, due within 1 accounting period, are shown first, followed by long-term liabilities, and finally, owner's equity, common stock and retained earnings. Sometimes, current liabilities and provisions might be presented within the asset side by subtracting them from current assets. And tangible assets are shown net of depreciation, and intangible assets are shown net of amortization. Assets are typically ordered by liquidity, from most liquid to least. Liabilities are ordered by payment priority, with current liabilities first. Thanks for watching.